Hi, welcome to our channel. New throne, Hurtis. Guys, as you can see, we got a new throne. Anyways, so new throne, Hurtis. Alright, so welcome back to our channel. My name's Sasha Qualkenbush. I'm a real estate attorney.
I'm Shannon. I'm a real estate agent and investor.
I'm Jackie Hurtis, and I'm a residential mortgage lender.
And we're
The Property Queens.
Thank you, Sasha, for making mortgage insurance sexy in this video. Let's talk about what mortgage insurance is. When borrowers come to it, it's kind of a dirty word in our industry. Everyone wants to avoid it at all costs. But the reality is, if you're a first-time home buyer or you don't have 20% to put down, 9 times out of 10, you're gonna have mortgage insurance wrapped up into your loan some way, one way or another. Mortgage insurance is something that you pay. It does not insure you at all. It insures the lender against default. So if you stop making your monthly payments, the lender can recoup some of that money. So it doesn't help you at all. The only way it helps you is that it allows you to get into a property before you have that large lump sum to put down on a mortgage.
How do you pay mortgage insurance?
So there are a couple of different ways that you can pay it, and we're gonna really focus on conventional financing and FHA for this video. FHA, they have upfront mortgage insurance, which is 1.75% of the loan amount, and that's just wrapped up into the loan, so you're financing it throughout the 30 years or 15 years, however long your term is. Then they also have a monthly fee, and that depends on how much money you're putting down at closing. Conventional, there are a couple different ways to do it. Most common by far is monthly, but you can also do single premium where you actually buy it out on the front end. You can also do lender paid mortgage insurance, so it's taken out of your monthly payment, but they boost your interest rate a little bit. So you're never really going to get completely rid of mortgage insurance unless you do the 20% down conventional at the beginning.
So how much is it usually?
So we're gonna focus primarily on FHA and conventional loans for this video. With FHA, it's pretty standard. If you're doing minimum down payment of 3.5%, your monthly mortgage insurance will be 0.85% of the loan amount, and that's just wrapped up into your monthly payment. They also have upfront, which is 1.75% of the loan balance. You can't get rid of that. It's with you for the life of the loan. With conventional, it varies dramatically depending on your specific file. Credit score is huge. Down payment, how much you're putting down, term of the loan, and then your debt to income ratio. So they made fun of me for having my cheat sheet here, but it really does vary so much that you really have to have something like this. So it can, like I was saying, monthly can vary anywhere from 0.17% up to 1.86%, just depending on your credit file. So this just kind of brings me to conventional versus FHA. A lot of people are afraid of doing FHA because 9 times out of 10, you can't get rid of that mortgage insurance. But if you have poor credit or you aren't putting a ton of money down, sometimes your monthly payment would be cheaper going the FHA route and not going conventional. So it's important that you're working with a lender who's looking at both options for you to help you determine what's going to be best for you.
And at what percentage usually of the paid off mortgage does it fall off?
So if you go conventional route, once you have 20% equity in the property, you can request it off. It'll fall off automatically once you get to 78% loan to value. So once you get 22% equity in the property. With FHA, common misconception is that there's no way for it to ever fall off. That's not true. If you do a shorter term or 15-year, or if you're putting 10% down or more, there are situations in that case where the mortgage insurance falls off after, I think it's like 11 years in the house. But 9 times out of 10, if you're doing FHA, you're probably not doing 10% down, in which case you're gonna have that mortgage insurance for the life of the loan.
Okay, so when you say equity, so can someone go get an appraisal done and then show, let's say that they've done renovations to the home and it increased the equity 40%?
Yeah, so like I said, it's gonna fall off automatically once you get to 78% loan to value. That's based off of the value that we had at the beginning of the loan. But if you think the value's gone up, you think you have some appreciation there, you can reach out to your servicer and request that. And they'll take a look at it, and if you're at that 80%, they will drop the mortgage insurance at that time.
How do you pay mortgage insurance?
So with FHA, we kind of went over this earlier. there's going to be that monthly fee that you can't get rid of, and then the upfront fee, which is wrapped into the loan amount. With conventional, there are a couple of different ways to structure it. By far, the most common is monthly. Whenever you get a quote from a lender, 99% of the time you're going to see monthly on there. But if you are putting a little bit more money down, sometimes you can look at doing single premium, where you actually buy the mortgage insurance out on the front end, so you avoid it in your monthly payment. It makes your monthly payment a little bit lower. You could also do finance mortgage insurance, where they actually wrap it into the loan amount itself. That also makes your payment a little bit lower, but there's no way to get rid of it at that point because it is part of your loan balance. So you're going to be paying on it for the next 30 years. And then you could also look at doing lender paid, where it's taken out completely from your monthly payment, but you take a little bit higher interest rate, which can be good. Talk to a CPA about this, but you can oftentimes write off the interest that you pay on your mortgage on your tax returns. So each one of those is a really great option for specific people who are in specific scenarios. Make sure that you're talking to your lender about your different options. If you know that you're only going to be there for a couple of years, it wouldn't make sense to buy it out on the front end, because that's a cost that you're not going to see the savings. You're not going to get to that break-even point by paying it up front. If you know that you're going to be in there for the full 30 years, doing finance doesn't necessarily make sense. So that's why you want to sit down, talk with your lender, make sure that they're doing what's best for you or your situation.
Hope you like our new throne as much as we do. Better than Game of Thrones.
No way. False. False.
Yes, way.
You guys don't even watch the show.
But we do watch these videos.
Yes.
And you should too.
And you should be subscribing, liking, tuning in every Tuesday, and sharing with all of your friends.
I like this ending.
Also, hit our contact information and contact us also. Till then, we will see you next Tuesday.
Bye.
Bye.
That was the best ending we've had. That was the best ending